Welcome to Teachers Talk Money, where a millennial high school teacher and a Gen X elementary teacher get together to talk all things money.
From salary scales to saving, investing, and self-care, we're here to help teachers master their money. I'm Christy.
And I'm Rachel, and we're so glad you're here.
Hey, everybody. Welcome back to our Summer Money series. We are so excited to be here with you and so thankful that you're here. Just before we jump in, if you're getting a lot out of these episodes, we would love it if you could please leave us a review and give us a 5-star rating and subscribe so that more teachers can find us. Our audience is growing, and the more feedback we get, the more people can find us. Also, if you have any questions or want to share a money win, remember you can always email us at teacherstalkmoney@gmail.com. So, Rachel, how's it going?
It's good. I'm excited to be back and recording with you. My update is very small. It's just that I found a life enhancer and it's half caffeinated coffee, which is weird, but hear me out. So
Okay.
While I love coffee, I'm not like a 2-cup a day kind of person, just because I'm like really wary of just like getting super addicted to it. And so I've really always limited myself to 1 cup a day. But if I do 50% decaf coffee, then I can have 2 cups a day.
Oh,
for the caffeine
math.
One. Yes.
Coffee math.
I may be an English teacher, but I'm pretty sure this math is rock solid. So I just love that, especially now that it's summer and I actually like am home more, that I can like make 2 separate cups. But even over the school year, I'm definitely going to do this on the weekends and stuff. And just so I can enjoy that second cup without feeling like I am sliding into an addiction to caffeine. How are you though, Christy?
Well, I'm so good. And I have so many things to say right now. First of all, I was actually thinking last night, like, I am so happy that Rachel is on my team and I'm on Rachel's team.
Yes.
I just love you. And I'm so glad that we've built this. I'm so grateful for you. Regarding coffee, I had major insomnia issues about 8 years ago, like where I did not sleep at all. And we tried everything to dial it, and get it fixed. And my doctor was like, just stop with the caffeine. Because I was fully rocketing myself into every single day with like tar black 16-ounce cups of, just all morning long. And so I quit because I was like, well, I need to sleep. Like that's just non-negotiable. But it is lovely because now all I have is decaf and I love it every single morning. And yeah, if I want another cup or two, it's just a luxury that I can enjoy and not have to worry about any complications from the caffeine. So while I do on some mornings miss that little boost, I've had to stick with it just for my own health. And decaf is so fun. It tastes the same and you don't have to worry about the jitters. And then it's such a fun time to be in my house because we tore up all of our grass about a decade ago and planted a native plants garden in the front yard. So it's just so fun to see everything bloom and all the birds and insects that come. We really, really enjoy it. So it's just a fun time of year to be able to be at home and enjoy that and just be part of that little mini ecosystem in the front yard.
That sounds lovely. I really wish I had some outdoor space to have a garden myself.
So before we launch into this episode, I have just noticed recently in my perusings on social media and podcasting that there seems to be sort of a difference between teachers and educators. And that if we're saying teachers, maybe we're not including all of the awesome people that work in our schools. And I just wanted to make a note that if you are a speech language pathologist or an OT or any other invaluable human in our building, we definitely want you part of this conversation. We are using Teachers Talk Money. It's lovely alliteration, but we are not in any way trying to exclude anyone who doesn't call themselves a teacher, but works with kids in our schools. So everyone is welcome to this table, and we're glad you're here.
Mm-hmm. Yeah, I totally agree. So what are we going to talk about today, Christy?
So we have done so much work already on investing and how that works and how to get into it. And today we want to really get to fees and funds, because we've gone through all those investing myths. Maybe you've got an account now to open or to add to your current portfolio, and you're thinking, oh, what's next? Like, how do I know what to do next? So two of the most important factors when you're investing are fees and funds. Whether you're investing on your own or working with an advisor, you have to learn about the fees you're paying and how they're affecting your long-term earnings. And fees can come into play in two ways. When you're working with an advisor and essentially paying someone to invest for you, and when you're investing in index funds, which is primarily what we'll be talking about. A general term for fees that you'll hear a lot is expense ratio. And it's also like cost basis or basis points. Those are related terms. And an expense ratio is typically described as a percentage of your account value that will be taken off the top to cover the expenses of operating the brokerage firm, managing the fund, and paying your advisor if you have one. So expense ratios can range from 0 and at some funds to like a 0.04% or something like 3%. That may not seem like a big deal. You're like, whoa, those numbers are super tiny. But we're very excited to be talking about them in this episode because they are actually huge in terms of impacting your overall balance at the end.
Now, the question really for a lot of people, I think, is do I self-direct my investments or do I go ahead and hire a professional? Regardless of what you choose, you have to know the basics. Don't just say, oh, I'm going to hire a professional because I don't understand any of this, because you will probably be playing yourself out of a lot of money if you don't know the questions to ask your professional if you do want one. And you may also just not need one depending on your situation. Mm-hmm. You need to know what your advisor is taking in fees and know the fees that come with your funds as well.
Yeah, and I actually started with an advisor. It was a local guy who came to my union, gave a little talk, seemed nice. And I was like, okay, I really want to start investing. Like I was young and I didn't know anything about it. And so I contacted him and he set up IRAs for us. Actually, we just started with one for David. And we started with literally $50 a month. So side note, no amount is too small to get started. Definitely don't let that stop you. But in our conversations with him, he told us the fees and he picked the funds that kind of lined up with what we said we were thinking we wanted. And then I read a couple of books by the Motley Fool brothers who are hilarious. And I just learned so much from them. And I realized that I had no business paying anyone a 3% fee for something that I essentially could easily be doing on my own. And that's what his fees were. They were at 3%. And he was like, oh, yeah, it's no big deal. And so a year in, I transferred all of our accounts over to Vanguard and started managing the Roth IRA we had set up and then have since added a bunch of accounts. So learning about those fees was really critical in changing the path that I'm on. What about you?
Well, one of my weaknesses, maybe my only weakness, no, just kidding. One of my weaknesses is that I will always try to DIY things. So I really, especially in the beginning of my money journey, was like, I'm not paying anyone for anything. That has since changed. But even still, I do have this sort of like toxic independence where I want to do things on my own, figure them out first, and then only ask for help as like a last resort. So this is a problem because obviously sometimes hiring somebody is a really good idea and the smart move. So the thought of working with someone on my money was just not a thing in my mind. So I never used an advisor, which in a lot of ways, I'm really glad I didn't. This weakness just happened to pan out in this situation. There are, of course, situations with your money where you do want to hire a professional. I think like an accountant is a situation where you want to hire a professional in a lot of cases. But in this case, I have become actually very confident in managing my own investments. I was able to sort of alleviate a little bit of my insecurity with it by going the robo-advisor route. And so I just really didn't ultimately need one. And so I'm glad that I never like you, Christy, just like met somebody and signed up for it because it seemed like the right thing to do. So I'm happy in this situation that I didn't hire a professional. That doesn't necessarily mean, though, that just because you and me, Christy, self-direct, that everybody else should, because there are obviously some situations where it might work.
Definitely. So let's zoom in a little bit on why fees matter if you're working with an advisor. So I will link to a couple of fee calculators in the show notes. And that's where you can literally go in and plug in how much you're investing, what your rate of return is, and what your fees are. And it will show you the differences. You can adjust those fees and like compare different results over time. I'm not just like doing all this math on my own. There's a lot of them out there, and I've used lots of them, and they're reliable in terms of the results they give you to use that data to inform your decisions about fees. So first of all, there's different fee structures when you're working with an advisor. Most advisors are fee-based, meaning they take a certain percentage. Like my advisor that I started with was taking 3% of my account balance every year. And I never saw that. It was never itemized, and you won't really see that, which is another reason why it's so important to know about fees. It's never going to say, here's what we took from you and here's what it cost you in the long term. They just literally, I've never seen it on a statement. So that's fee-based, and they take a percentage of your account value on a certain, timeline. And then there is the idea of fee only. And fee only is where you pay them for their time. Like you'd make an appointment with your financial advisor and pay them $150 for that hour of time to do exactly what you need within that time. So it's like a one-time fee that you're paying them versus them taking a certain percentage for the entire life of your investments. So fee only is a great way to know exactly how much you're paying and only pay for what you need. It's also not as common. And especially I've noticed in like our 457 and 403B offerings from my district, there is no fee only option. So let's take $6,000. Let's say I invested $6,000. I'm maxing out my Roth IRA every year for 30 years, and I'm having an advisor do that for me. He or she is transferring the funds and putting them into my account and purchasing index funds with them. So $6,000 a year for 30 years, if my advisor is charging me 1.1%, it will end up costing me $91,000 over the course of that 30 years. $6,000 invested every year for 30 years with a fee of 0.04% because I'm self-directing to invest in those exact same index funds will only cost me $3,700.
Wow. So that is literally a difference of over $85,000 over your lifetime.
Yes. And again, if that advisor is an essential need for you, a 1.1% fee is actually really reasonable for an advisor. And remember, I started out with an advisor that charged 3%. And at the time I was like, oh yeah, 3%, no big deal. That's the way he literally told me. He's like, yeah, it's only $3 out of every 100. What's the big deal? And then when you realize I'm not losing that $3, I'm also losing all of that compound growth that we talked about, that $3 could earn me over my investing lifetime. So if I invested $6,000 every year for 30 years with my advisor for a total expense ratio of 3%, it would have cost me $256,000.
That's a house.
That's a lot of things.
That is a house. Not in anywhere near my area, but that's a house in some places.
Yeah. Or like, a lot of things, college education, retirement. I mean, just years. And so that is where you have to think like they're tiny numbers, but their impact over a long time when we're taking into account compound growth and what we're missing out on that money earning over that time, they add up so quickly. And the difference between 0.04 and 3% is literally hundreds of thousands of dollars. Another way to think of it, we've been talking about like average market returns being between 7 and 10%. So let's say your average returns are 7% on your total market index fund, and your advisor is taking 3%, that shrinks your earnings down to only 4%. And so that also it's basically cutting your earnings in half. And so that it's just really powerful and I have yet to meet a financial advisor that has told me that information.
Yeah.
Yet to sit through a district workshop where they've said, hey, this is how fees impact your future earnings. Like they mention them kind of in an offhand sort of, no big deal way, but no one's leading with this information. And so it's critical that teachers know how impactful those fees are on your bottom line when you're ready to enjoy that retirement.
Yeah, because of course, I think maybe with our districts, it might just be a case of like, they don't really understand themselves necessarily. And then with advisors, why would they say, yeah, over 30 years of your investments, you're going to end up giving me $250,000.
Well, and you're not actually giving the advisor that much.
Right.
You're giving them part of that, but then you're
Right.
also losing that in the earnings of that money.
Yeah, that's exactly right. So there are some situations, of course, where you might want to work with an advisor. Hopefully you don't have to be spending 3% on your advisor. Maybe you can get something closer to that 1%. It's possible that you might want to work with an advisor just because you don't want to learn all of the little nuances on your own, because that's daunting. Now, I want to empower everyone to understand that you can learn everything you need to learn about your investments on your own. But if you're in a situation like this to start, it doesn't hurt to hire an advisor now and commit to learning everything you need to learn to be able to be a confident investor in the future. Now, maybe your situation is just super complex. Maybe your spouse has a 401k job and stock options or a wacky bonus structure, and it's just super complex for you to navigate on your own. And this, I think, is really valid, right? Maybe you have rental properties and you want to make sure you're complementing that income with your investing in terms of risk. Maybe you just got married or divorced, or you need some help updating your finances to work with whatever new situation you're in. I think that all of those are very valid as well. And then, of course, for some of us teachers, you might actually have to work with one for your district-sponsored retirement stuff. So for your 403B or your 457. And Christy, you're in a situation like that. Is that right?
Yeah, we actually just brought on a self-directed option with Aspire Financial Services. But up until now, I've been working with someone through AIG to create my 457. I had to use her as a gatekeeper. Luckily, her fees are under 1%. And I told her exactly which funds. I picked the funds I wanted to be in within the list that is offered through her brokerage. So it's a reasonable rate. And she's actually given me some really awesome benefits. One of the things she can do is put in our numbers and project them out into the future with things like inflation and Social Security and retirement and estimated lifespan. And that has been amazing because she's been able to give David and I the confidence to go beyond my sort of approximated math of how things should work out in the future with factoring in all of those variables. And I could not be doing that on my own. So that has been one perk of having to work with someone. And I really have appreciated that. And I'll also say, you know, I listen to a lot of women-run podcasts that I've been surprised to hear them say that they really love their financial advisors and they work with financial advisors. Because I kind of saw it as like, oh, they should be self-directed and like forging the way. And then it's like, but okay, these are really, you know, their finances are way more complex than mine are. You know, they have multiple income streams and multiple businesses. And, you know, in that case, and in any case, really, I mean, if you're a single mom with 3 kids and you want to pay an advisor to set that stuff up for you, do it.
Yeah.
You know, I mean, anything that just feels like too much, there are advisors out there that are amazing and can help you. And we're going to give you some resources to find them. So if you're feeling like you can learn this and be self-directed, great. And if you want an advisor, use one, definitely. One of the best resources that I've heard about is called Wealth Ramp. It's one word, like a ramp into wealth, Wealth Ramp. And you can find it online. It's created by Pam Kruger, who is the co-host of Money Track on PBS. It's a free resource that helps people connect with independent fiduciary advisors. Fiduciary means they have a legal obligation to act in your best interest, which surprisingly, not all advisors do. And all of their advisors in the network are fee only. So you know their fees right away and you can pick what works for you. They're also fully vetted according to their education, their SEC record, and their experience. So all that like hard work is done for you. You can screen advisors for areas of specialty like taxes or socially responsible investing expertise, as well as gender and geographic location. So you tell WealthRamp what you're looking for in an advisor, and they use their enormous network to connect you with options. And then it's kind of like those dating apps where like the woman is in charge. I don't know what they're called because I don't use them, but I know there are some where like you get the names of the potential matches and then you initiate the contact. And that's how this works. They have fully vetted these financial advisors, and then they hand you 3 names that they think might be a good match for you. I just think that's amazing because it's available to everyone. And what a great way to get started, and know that all the hard work of the vetting and the research has been done. And then you get 3 highly qualified people to potentially work with.
I love that. Yeah, if you're spending your time on dating apps, this is a much more fun and profitable, potentially, way to use that same kind of software. That's so funny. And I had never heard of that. That's really awesome.
Yeah.
So let's move into talking a little bit more. We've obviously covered this in the previous episodes, but we want to get into a little bit more of the nitty-gritty of how to self-direct your investments if you don't necessarily want to go the advisor route. Self-directing is very simple. It's easy, quick, inexpensive, and you basically just go and open up an account. Some popular ones are Vanguard, Fidelity, and M1 Finance. There are tons out there, but these 3 specifically, Vanguard, Fidelity, and M1 Finance, have crafted their services specifically for investors who are self-directing, and it takes about 10 minutes to set up, and you can go in and learn more from there.
Yeah. And this would be an example of like how to open an IRA or a Roth IRA. That's kind of the starting point that you might be using to start with one of these brokerages. And just, we're not endorsed by them or sponsored by them or anything like that. It's just our personal experience in the brokerages we've used and also heard a lot about in the personal finance world. So once you open your account online, you link up your bank account, and then you transfer money into what's called a sweep account or a money market. And it's basically like a holding space for your cash. It's where your cash sits until you decide to purchase your index funds. And I've got an article on my website that kind of walks you through literally step by step, sort of the questions they ask you in the drop-down menus, but it's really, really pretty quick.
Yeah. And then there's, of course, the robo-advising option, which we've talked about before. And it's the option that I use right now for my Roth IRA. It's lower cost usually than hiring an in-person advisor. But of course, just like you would with your real life people advisors. Why can I not find a not awkward way to say that, but whatever. Just like you would with your real life people advisors, make sure that you are comparing fees between each robo advisor, because some of them do have higher fees. I mean, I'm sure there is a robo advisor out there with those 3% fees that we were talking about, right? But even if it's a difference between a 1.5% fee and a 0.5% fee, make sure you're comparing. I use SoFi, which again, not sponsored yet, but get in touch with us, SoFi. I use SoFi because it's a no fee option. So the only fees I'm paying are for the different funds that it chooses. But there are lots of other low fee options that might have other features that make them a good fit for you. But you can compare all of their features using NerdWallet, which is a really great resource for comparing all kinds of things. Just be aware that I think sometimes NerdWallet is paid to advertise for some of these. So really just use their comparison charts and use those numbers to compare the fees and the features and see which one is the best for you.
Yeah, I love NerdWallet. So to recap, you've now learned a ton about how to start investing. And you're thinking about, am I going to be comfortable self-directing or do I want to hire an advisor? The next question is, what do you actually invest in? And this is the part where people are often most worried because they're like, oh, what if I pick the wrong fund or the wrong stock? And it's also what we really need to worry about the least, because starting simple and keeping it simple is key. You can have a really dialed, relatively low amount of risk and low expenses and own literally 1 or 2 funds in your portfolio, and you're going to cruise. I mean, obviously there's no, I can't predict the future and things could change, but historically speaking, simple investments and low cost index funds have outperformed the pants off of actively managed, super fancy funds. Furthermore, Morningstar, which is a firm that rates and reviews mutual funds all through the stock market. They do a ton of research on the market. And they did a study in 2016 showing that fees were the number 1 determiner of future success of a fund, meaning any fund outperformed comparable funds simply due to their fees. And index funds usually have way lower fees than actively managed funds. So index funds consistently win this contest. And in addition to that, actively managed funds means, there's a person picking the stocks that go into the funds. And that person thinks that they're going to do better than the index, than just, letting an algorithm pick that slice of the market. And there's also tons of studies there that show that actively managed funds underperform index funds over and over and over again over the long term. So don't let thinking about which funds to pick overwhelm you. Just some simple, broad-based, low-cost index funds is a great place to start and is usually the best bet for long term.
Something that tripped me up with this in the beginning was, when I was starting to learn about these things and hearing sort of different advice from different podcasts and YouTubers, is that some people really said, you need to be investing in ETFs. And then others said, you need to be investing in mutual funds. Then also people would say you need to be investing in index funds. And so I had to kind of figure out what all of those different things meant. And essentially mutual funds and ETFs, which are also known as exchange traded funds, are both types of index funds. There are some nuances between mutual funds and ETFs. And as always, I encourage you guys to learn more if you're interested. But these differences are really small for the buy and hold investor. The main difference between these two tends to be entry cost. So, for example, with Vanguard mutual funds, you have to invest a minimum of $3,000. But to get an ETF with Vanguard, you only need to buy one share. So that's something that could potentially be an obstacle, right? If you have to reach that minimum investment. With Fidelity mutual funds, there isn't a minimum investment. And then for ETFs, you can buy fractional shares. So you don't have to necessarily be able to buy a whole share. And there are tons of zero fee funds. So you don't necessarily need to get super caught in the weeds of should it be a mutual fund? Should it be an ETF? Instead, just focus on index funds, but pay attention to, of course, those minimum requirements, because that might be something that's a little bit exclusionary based on your situation.
Yeah, the ETF or exchange traded versions are typically more accessible because you don't have to have a minimum investment like with Vanguard. I think when I opened my M1 account, there was a minimum investment of $100, and then I could invest in any fund through Vanguard or Fidelity using M1. So yeah, index funds are mutual funds, and there are mutual funds that are not index funds. But like Rachel said, just focus on that index fund, and then you're either buying it in a mutual fund version or an ETF version. They hold the same stocks. There's comparable funds that hold the same stocks in both forms. So to give you an example, and again, we're not saying go buy these funds or you must do this or that. This is all intended just to help empower and educate you so you can make the decisions that best fit your situation. And that applies to kind of all the information we're offering here. But here are some tickers. And a ticker is the short name that the market uses to name a fund. So here are some tickers for some very common index funds. One that you'll hear a lot about is VTSAX. And that is the Vanguard Total Stock Market Index. And that's the one where you're holding a little slice of all the companies in the US market. And actually, the bigger companies, you're holding bigger slices of those, but you are holding the entire US stock market. If you wanted the exchange traded fund or ETF version, it's VTI. Another example from Fidelity is FZROX, Fidelity Zero Total Market Fund. And that's their zero fee equivalent to Vanguard's Total Stock Market Index Fund. Those are kind of just some examples. There's also bond market index funds, like in Vanguard, it's VTBLX for the mutual fund, and then BND for the ETF version of that index. Once you get on those platforms and start kind of just doing some searches, you'll see they're really easy to find. And the platforms themselves do a great job of explaining what's in them and what the expense ratios are. Those platforms have it all front and center, which is really awesome for a self-directed investor.
There's also something called target date funds. This is a fund where it takes your retirement date into consideration, because the idea with investing is that, especially when we're thinking about retirement, is that you can be pretty high risk in the beginning when retirement's very far away, because you're getting more opportunity for reward. And also you have a lot of time in the market to sort of settle the short-term bumps in the road that happen. When you are far away from retirement, and your target date fund will keep the risk high and, of course, the rewards high as well. And it will slowly lower your risk as you near retirement age. Every year, it changes the makeup of the fund. And they do this by adding more bonds to the fund instead of stocks, because bonds are traditionally much lower risk than stocks, but also, of course, lower return. So keep that in mind as well. And this means that you don't have to adjust your fund by yourself and adjust your fund choices as your risk level changes throughout your life, because it just automatically does that. And of course, target date funds made up of index funds are also very easy to find.
Yeah, target date funds are really great option because they, like you said, they change that allocation based on the average person of your age and distance from retirement's level of risk. And so those can be a great thing to start with. And then as you're learning more, you might want to tweak it a little bit here or there. But yeah, there's so many great ones out there. And it's literally like a one click, this is when I want to retire. And it sets you up with that ratio of stocks to bonds. So when you're thinking about how to get started with investing, we're kind of like wrapping it all up here. You want to think about fees, and you want to think about index funds. You want to consider taxes. Do you want to have a Roth account or a tax deferred account where you pay taxes later? Your contribution limits, and if you want to start with your district, moving things for you or not, if you want to go through an independent brokerage. So those are kind of the key factors that we're kind of weaving together now at the end of this 3-part series about investing: fees, funds, taxes, your contributions, and whether or not you want to start with your district. All of that being said, all of the things that we've gone through, and there's so many fun things to learn, as my husband would say, don't overthink it. If you're starting somewhere and investing for yourself and your future, you are doing a great thing for yourself. For many people, a Roth IRA is a great place to start. If you open a Roth IRA and then you learn next year, oh, actually a traditional IRA is going to be a better choice for me, the world is not going to end. And if that money is still going to be there and grow for you. And if you want to change the funds because you're like, oh, I learned a little bit more and I want more of this or more of that, you can do that within these retirement accounts easily. You just trade one fund for the other fund. So nothing is set in stone. And the whole point is that you're starting and you're building that investing habit. So get in touch with WealthRamp to find an advisor if you want, and celebrate that you know enough to ask the right questions and find out the information that will have the biggest influence on your investing future, whichever direction you decide to go with all of this. And don't let any confusing moments or questions that you have stop you from continuing to move forward, because this really is so powerful, and we don't want anybody missing out on it because they feel like it's too big or too much to take on or understand the basics of.
Yeah. So just do it. Like David would say, Christy's husband. Don't overthink it.
He's never said just do it. That's Nike, I think. But
I know. I was starting the new sentence like David would say, don't overthink it. But yeah, just keep learning, keep investing. Don't withdraw your investments every time the market dips. Leave it alone. Buy and hold. Because like we've talked about before, timing the market is a bad idea, and it usually doesn't work out in the investor's favor. But having time in the market is the key to growing your wealth.
Definitely.
If you would like to learn more, please read the book I Will Teach You to Be Rich by Ramit Sethi. I love this book. I actually listened to it on audiobook. I kind of wish I had bought it though, because he's got like some nice like tables and graphs and things in the book too. So I'll probably eventually buy a copy. But what I love about this book is that it's incredibly simple. It's easy to understand. It's in plain English. It's super clear. That is so helpful, especially when we're talking about something that seems so intimidating like investing. So I totally think that if you listen to these episodes and you want to learn more, that I Will Teach You to Be Rich is an awesome option. I will say that I don't really agree with everything that Ramit says in this book, because he's not a believer in the budget, actually. He says you should just automate your savings and investments, and then you only have what's left over to spend. Whereas I think that, the way you spend your money is really important too.
Mm-hmm.
But I really like the way that he talks about investing because it is just so easy and simple. And he is super aligned with my unfrugal money mindset. He's all about living your rich life is, I think, the way that he puts it.
Mm-hmm.
So if that resonated with you also, and you're interested in learning more about investing, I would highly recommend this book to you.
Yeah, and I love that automation piece. I don't think we've talked a lot about that, but that can be really key in terms of getting money into your investments because you can automate your contributions to a lot of these accounts. But then, yes, I prefer budgeting too. We hope that you've enjoyed this and gotten a lot out of it, and it's been really empowering and educational. And we hope you tune in next time because we'll discuss the order of operations. So sort of like, when do I put more energy into paying off debt versus investing, or maybe doing both, and really kind of pull together how all of these building blocks come together to build your financial palace. Because there are definitely some things to consider, and we're excited to talk about those next.
Have a great week, everybody. We'll see you in the next episode.
Thanks so much for joining us here on Teachers Talk Money.
Subscribe now to make sure you don't miss a future episode.
Leave us a review of this podcast. It helps more teachers find us.
Share it with a teacher friend who can use some of this information.
You can find more money advice from Christy at Financially Fit Teacher on Instagram and Rachel at Teachers Talk Money on Instagram and YouTube.
All opinions are our own, and our awesome theme music is by John Bartman.